unemployment numbers are going in the negative a little bit. So that's going to help rates more than the PPI and the CPE did. Not only are people losing their jobs at a faster rate, but those who are gaining the benefits are trying to extend those benefits. For the juice to be worth the squeeze, if we're measuring apples to apples, right? We're looking at hundreds of thousands of dollars.
I'm Karl Kyler, your San Diego realtor, and we're back with Mortgage Talks with Matt.Kish of Movement Mortgage. Matt, thank you and welcome back.
Thank you so much for having me.
Okay, let's jump into this. Let's just keep everyone updated. CPI reported positively, Consumer Price Index, let me make sure I get that right. Then we had PPI also report positively, up but lower than expectations. How is that affecting rates, if it is at all?
Not really. Those two factors really didn't affect the rates at all, which was a good thing, right? Because if those numbers were a little better or a little worse, maybe they would have swung the pendulum one way or the other. But they stayed flat, so rates pretty much stayed flat. What really kind of moved rates in between our last talk and this talk was the BLS jobs report. And truthfully, that jobs report has been wrong the last 5 months. And we talked about it last month, how they keep revising these numbers after the report has come out. And seriously, I don't know of any occupation, job, industry where you could be this wrong and still keep your job. But it is what it is. It's kind of the territory we're living in these days. And we kind of got to just roll with the punches. But this BLS jobs report has been revised to the tune of over 300,000 figures, 300,000 jobs to the negative after that's come out combined over the last 5 months. So I'm kind of worked up about it because once this jobs number comes out, it hits the bond market hard, and then they get revised and we start picking up, good momentum. And by the time we picked up that momentum, the BLS comes out and we get knocked back down a peg. So it's been this cycle of bad numbers with the BLS, then picking it back up, getting the momentum going back up just to get it knocked back down with the next jobs number. So unemployment came out a little stronger, strong unemployment in terms of the jobs numbers have gotten worse. So unemployment numbers are going in the negative a little bit. So that's going to help rates more than the PPI and the CPE did.
Okay, let me make sure I got that right. So unemployment numbers came in stronger, meaning that unemployment rose or it came down?
It rose, and people that have been on unemployment claims have wanted to extend those claims longer. So not only are people losing their jobs at a faster rate, but those who are gaining the benefits are trying to extend those benefits for even longer.
Got it. This makes sense. I heard an economist recently talk about one of the challenges we're having is our unemployment is really, really low, but our new job openings is super low as well. So if a uptick in unemployment hits us significantly, right? A significant uptick, then we don't have the economy opening up new jobs for these people to fill in. And that kind of just goes in line with what you're saying. More people on unemployment are extending their unemployment.
Yeah, those who are on benefits are remaining on benefits. They're not entering the job market and getting those numbers higher, right? They're keeping on the unemployment numbers. So with stronger unemployment numbers like that, the bond market's going to react kind of favorably for us. But again, like we've been saying since we've been meeting, it's been touch and go, and a little bit of news here or there will really sway the pendulum one way or the other.
Yeah, and for our audience, let me see if I can just recap the significance of following unemployment and the jobs, and help me or back me up if I kind of derail this. With low unemployment, the market sees the economy with a lot of strength, so they tend to invest more in the economy, less in bonds. But when unemployment goes up, then that reverses and investors move their money out of the economy, out of stocks and such, and moves it into bonds, treasuries, and then that's what would bring our mortgage interest rates down. So this is kind of one of the things where I've heard lots of economists. One of my favorite ones is Logan Moshami from Housing Wire. He talks about how we're not going to see lower mortgage rates until we see labor market break. Is that accurate?
Pretty much. And it's going to go hand in hand, right? Because If there's more people working, there's more money to put in the economy, and that, a little more money to spend, you're going to put it in the stock market where it's a little more risky than you are in bonds, and the yield's going to return negatively. But again, if the unemployment's going up and people are looking to move their money into a safer bet, they're going to move it into the bond market. And keep that safety net with their money. And as we see the unemployment numbers gain up and get a little higher, you're going to see the bond market get a little more favorable with the money moving over there.
Got it. That makes a lot of sense. Okay, let's move on to the next topic that is showing up a lot in my comments. And also I'm getting this a lot from my clients that I'm like starting to work with, and I'm really hearing this a lot when I'm out in the field hosting open houses and such. Buyers are expressing like this aggravation, this frustration, almost like to the point of depression, that prices are just too high, and they're thinking that the solution to the affordability issue is that prices have to come down, and they're like praying, or they're expecting something significant like 2008, where we're gonna have this massive decline of 20, 30, 40% to levels where it would then make it affordable. And I try to educate them. It's like, hey, 2008 was an anomaly, and we don't have any of those dynamics that were going on back then in that market. And you've talked about this in past episodes when we talked together about how equity didn't exist back then, and we have tons of equity in the market right now. We don't have any of those dynamics that would cause this flood of homes to come to market that would essentially bring down the prices. But what is an answer or a direction or a solution to affordability is interest rates. Could you give us any insight on the weight of either a price reduction in the market versus a rate reduction, and like which has more weight, which would make affordability a little bit more realistic or easier for the consumer?
I think right off the bat, it's going to be rate, right? I mean, that's why you're seeing these temporary buy downs be so relevant and so prevalent in these offers that we're writing, right? $15,000 up front will save, in some cases, $1,200 of mortgage in the 24 months that we're buying this down. So it's definitely going to be in rate. It's definitely going to be in rate. Depending on your loan amount too, is going to be dependent on how much you save. But let's just round numbers, a $500,000 loan, one jump in rate, that's going to be about a $600, $700 difference in your monthly payment, right? So that's going to be way different than what $10,000 looks like broken down over time, right? Where that's going to be $40 a month when you're looking at $600 a month with 1% lower rate, as opposed to getting the purchase price down even $50,000, right? If $10,000 is $30 a month, then $150,000 is $150 a month, right? So what's greater, $600 a month or $150 a month? So again, I think the best value when it comes to this argument is always going to be rate.
Okay, I see you're saying. So I think there's two points that we should probably pay attention here. One, a small adjustment in interest rate has a pretty significant impact on your payment. So even if you're talking at 1 point, which is pretty significant, you're saying 1 point could be up to $600. Well, shoot, a half a point would be roughly $300. That's significant. That is a qualifying difference for a lot of buyers.
100%. And as you're looking at the pricing sheet, right? Most price sheets go by eighths, right? So every eighth down the line or up the line, however you're looking at your rate sheet, is going to have a cost associated with it. And yeah, every eighth matters. And as you're looking at the eighths, you're looking at how much does that cost, and how much does that cost in purchasing price, and how much does that cost in rate. So you definitely have to weigh the two, and more times than not, it's going to be rate is going to outweigh the purchase price.
Yeah, and I guess the second dynamic then would be how accessible or how realistic it is to obtain a price reduction significant enough to match that of a rate reduction. Like which is in closer reach, a half a point reduction or the equivalent price reduction, that would be, I think you said 50,000 maybe, or
it would, for the juice to be worth the squeeze, if we're measuring apples to apples, right? We're looking at hundreds of thousands of dollars.
Got it. I didn't realize it was gonna be that steep.
Yeah. So right now you're looking for every $100,000 in purchasing price, right? We're looking at about $700 a month in monthly principal and interest payment, right? It just round numbers. So you figure going up the scale, that's kind of where we're at and where we're sitting. So every $100,000 is going to be 700. So for 500,000, we're looking at $3,500 a month, so on and so forth. So when it comes to rate, it's going to have a much more significant measure when it comes to your monthly payment every tick down than it will on purchasing price. It just will.
Got it. And I think another thing that we should probably express for the consumer and the audience is that with the temporary rate buy downs, so if you're watching this video and you don't know what temporary rate buy downs are, we'll cover it briefly, but if you want to go back to the last video that Matt.Kish and I did together, he talked about them there. But temporary rate buy downs are an easy, accessible solution now for buyers in today's market. In many cases, the tides are starting to shift where we can even ask the sellers to possibly cover that cost to do that temporary buy down, which allows the buyer to get into the home now and ride the market conditions out now, where we don't have as much buyer competition. We have more inventory, and it allows a buyer to get in now, start investing in their future, in their own personal property, in their own personal investment, in their own personal home. And then when the rates do come down that half point or that full point, I know there's some expectations that we're gonna settle under 6% from like Fannie Mae, Freddie Mac, and FHA. Once we do get to that point, then they can do a full, like a hard refi that's gonna fix their rate at that sub 6% or maybe 6% for the rest of their life of the loan. And that makes the process, the feasibility of getting to the market so much more accessible and possible now.
Correct. And to keep it really easy, right? What is a seller more likely to do? Knock $15,000 off the value of his home, or maybe come up with a way to give you that $15,000 in credit and still keep the purchase? Just without anything else said, what's probably more likely to happen, right? He's probably going to want to keep the purchasing price and give you the credit.
Yes.
So what are we then there we go. Now we're on our way, right? So now we have a little more wiggle room to get these seller credits, to use them in our favor, to get you a temporary buy down for 24 months. $15,000 is probably only going to get you about 24 months, depending on the loan amount, maybe even 3 years, depending on the loan amount, because there are, 3-year buy downs temporarily as well. But, get you in a 2-year buy down, get you comfortable with the mortgage payment. And hopefully in that 24-month period, we're going to sneak in a refi and we're going to get you at that comfortable rate anyway. And so not only did we get you in the house, we got you the rate that you wanted up front. We got you the comfortable rate, on the back end. And everybody's happy. The seller was happy off the bat too. So the temporary buy downs right now for affordability is a win-win. But at the same token, you still got to be comfortable with that qualified payment. You still got to be comfortable with the qualified rate.
I'm so glad you brought this up. In the last San Diego Market Matters video that I just dropped on Sunday, I talked about how, there's all this information out there, these headlines about how the market's turning into a buyer's market. And San Diego reported some recent numbers where we have a surplus of about 14% of buyers relative to sellers. But when I looked at the data from May, our purchase price on both the median and average sales price, they both ticked up. So we have this increase of inventory, this decrease in number of sales, our new listing inventory is coming down. But somehow, even though we have less sales, less things going into pending, our purchase price ticked up. And this is exactly why I talked about this. Buyers are instead of taking the price reduction, right? Instead of trying to negotiate the price down, they're negotiating credits. And then they're using that rate buy down, which is way more significant and sustainable for the home over 2 years. Because you also got to think, not only do they have the opportunity for interest rates to come down for them to do that permanent fixed refi, but it also gives them 2 years in their job to get their raises to kind of grow in their position in their career, either to get their natural raises or even to get a promotion or even to move to another job and get a higher wage there. So this makes absolute sense. I'm so glad that you brought this up. So it kind of like just ties into exactly what I was addressing in the last San Diego Market Matters video.
Right. And not only on top of the job growth in 2 years, because that's huge too, but for our first time home buyers, it's going to give you time to be comfortable with your monthly payment and maybe even find somebody else to take up that second room and supplement that mortgage for you. And then, man, you're on your way to even further affordability and comfortability.
Yeah, absolutely. I love when my first time buyers are entertaining this idea of like renting a room out. It's like, yes, that's such a great idea. I get so excited for them.
Yeah, keep building that wealth, man. Keep building that generational wealth. Know that your first home isn't usually your forever home, and just keep it as the building block for the next one.
All right, let's move on to the last question I have for this week's mortgage rate update with you. Median household income in San Diego County is just under 103,000, right? So you think about a median household income, let's just say 103,000 as a round number, 103,000. But our average sales price, our average sales price on a detached home is 1.4. On an attached home, I think it's like 850. On a median price, right? So we have average sales price, and we also have median. Median price for a detached home is 1.1 million. On the attached side, I think it's 650 or 600. 103,000 median income cannot afford those price ranges, but yet we still have buyers out there. So where are you finding these buyers that have these elevated incomes that are allowing them to still compete and uphold the values we have in San Diego County?
Well, that's a tough number to look at and be like, man, there's still people that can't afford anything, right? That's 100. Growing up, if you were making over $100,000, man, you were living on yachts, and that was the thought process, right? But now that's in San Diego terms might be on the lower end, but you could still find a place as a first-time home buyer making $100,000 a year with no debt. You could get a $400,000 condo. You could get upwards to about a $500,000 condo. $100,000, no debt, like 100% debt free, having a job for 2 years, good credit, and a down payment, at least 3% down. We could probably find you a place in between 300 and 500, but we can't go. That's pretty much where we're going to be capped at unless we have another borrower. That's just the reality of where we're at. Fortunately, with the rents being what they are in San Diego County, a lot of people who live here already kind of can afford an inflated kind of quality of life. So that benefits our surroundings as well. And there's a lot of first-time home buyers and young folks out there that are already making a really good, steady living out of college, man. There's good kudos to them. They went to school, did the work, and now it's paying off with their careers. So again, it's tough out there if you're not making at least that much for home ownership. But if you are making at least that much, there is a path to home ownership. Don't let it hold you down. Don't let seeing a number like, oh, you need to have X amount of dollars. We don't know what we don't know until we really dive in, because it's always going to be a case by case basis. And there's programs out there, San Diego County, San Diego City, Chula Vista, Poway. There's so many programs for those who are under the area media income to really see if we could get some down payment assistance. So don't let maybe news of area median incomes and sales prices and stuff weigh you down. We don't know what we don't know, but again, that's the reality we live in. 103,000 is the median income, and we gotta get people houses.
Yeah, an old idea that used to come up in the early 2000s when I was getting in my business is partnerships, and this can be a little dicey. So you got to make sure, like, I think that this is a good avenue that should probably come back of if you are making $103,000, or let's just say $110,000 or $100,000 just for round numbers, and you can't buy a home by yourself, but you have a very, very good friend that you've grown up with and you trust with your life, and they make $100,000 too, you guys should seriously consider having the conversation of getting into a place together and rent and owning it together and splitting that equity so you can qualify and just start getting in the market. Because the fact of the matter, I had someone ask me this one time, and I told them, I go, here's the fact of the matter. If you're $103,000 or less, you're not going to get into home ownership, period. Like, you're just always going to be a renter, and that's not a bad thing. Our rents relative to our purchase prices, they might feel high, but they're really super, super low. You got to put something down like 40 to 60% to break even on properties in today's market with where our rents are in San Diego. So it's like, why not be a renter if you can't afford to buy? Just invest in other things. But if you are really stuck on this idea of buying, either look at the first time buyer down payment assistance program, which you just mentioned, and also consider partnering. Take a silent investor. Ask one of your family members if they have equity in their house, if they would give you a loan from their equity to put down, and they would be a silent investor on the home. So you maintain the house, you get into the house. When you go to sell or whatever, maybe you decide to refi it in 5 years or 10 years and you put a renter in it, you move into something else, you pay them their money out and you give them a cut. Like, these are the conversations that need to start opening up again if you're in that low income bracket. I shouldn't say low income bracket, but if you're in that low income range and you really want to get into home ownership.
Yeah, or even, parents that are free and clear on their home, grandparents that are free and clear on their home, and they want to be non-occupant co-borrowers. Obviously, we'd still just have to add the taxes and insurance of their residence. But, even if they're on fixed income, we could still try to see if we can make the numbers work, and they could help you out too. But it's all, in that case, it's going to be a team effort, and we all got to go about it as a team to make sure that we, get these goals over the finish line.
For the buyers that are upholding these $1 million prices, where are these buyers coming from? Are these first-time buyers? Like, are you experiencing? I'm experiencing a lot of first-time buyers, and it's so ridiculous. They're buying between like 1.2 and 1.6. Now, mind you, they got really good incomes, and the biggest factor is they stashed a lot of cash, and they're getting help from family. That's how they're getting in. They're putting down something like $300,000 to $500,000, and they're buying at 1.4, and then it's dual income. It's usually two individuals that make good income, and that's how they're qualifying. Are you seeing this also on your side with all the buyers that you work with all over the county?
Yeah, that's basically, if we want to get up into that range, for first-time home buyers, I haven't found too many that are doing it on a sole income by themselves. A lot of family help, a lot of dual income help, a lot of squirreling money away for a long period of time.
Okay, well, that's it for this week's mortgage rate update with Matt.Kish of Movement Mortgage. If you are interested in purchasing a home, you don't have a lender yet, or if you're looking at a refi, his contact info is in the description below. If you have any other thoughts, questions, or concerns, don't hesitate to reach out. As always, I'm Karl Kyler, your San Diego Realtor. We'll see you in the next video.